You've probably seen this number floating around in the headlines, and it is a big one, $9 trillion. It's connected to the U.S. national debt, and yeah, it sounds pretty scary. So today, let's break down what it really means and figure out if it's the ticking time bomb everyone thinks it is.
So, what is this all about? When you hear that a $9 trillion bill is coming due, it's easy to think the country is about to slam into a financial brick wall. You gotta ask, is this the debt catastrophe we've all been hearing about for years?
And there it is, in all its glory, $9 trillion. Now, just to be super clear, this isn't the entire national debt, not even close. This is just the slice of it that's maturing, that needs to be refinanced within the next year. Still, that's more than a quarter of the entire country's debt. It's a huge number.
So the big, obvious question is, does this mean the government has to suddenly find $9 trillion in cash somewhere? Is it about to default on its debts? This is really the heart of the issue, and it's what we're going to unpack right now.
To really get what's going on, you first have to understand that the government doesn't just have one giant credit card. No, it borrows money in a bunch of different ways, and, crucially, for different lengths of time.
So here's a quick look at how it's all structured. You've got super short-term debt called Treasury bills, or T-bills. These get paid back in a year or less. Then you have the medium-term stuff, Treasury notes, and the really long-term stuff, Treasury bonds. And believe me, this difference between short-term and long-term debt is the absolute key to making sense of that $9 trillion headline.
Okay, let's dive right in and tackle the first big fear, this idea that the government just flat out doesn't have the cash to pay this back, which would lead to, a massive catastrophic default.
So the worry kind of goes like this. The government owes $9 trillion. Its tax revenue isn't anywhere near that high. So it has to go out and find $9 trillion in brand new loans, which, sounds pretty much impossible, right? But that whole way of thinking misses a really crucial piece of how government finance actually works. Here's the thing. The government almost never pays off its debt like you or I would pay off a car loan. Instead, it uses a process called rolling it over. Basically, when an old bond is due, the Treasury pays back that investor by simply selling a new bond and using the cash from that sale. It's this constant, massive, always running cycle of refinancing.
Which, of course, leads to the next logical question, right? I mean, even if it's just refinancing, someone still have to buy all that new debt. Where in the world is all that money supposed to come from? And the answer is pretty wild, because the money is already in the system, kind of hiding in plain sight. Take a look at this. The debt that needs to be rolled over is about $9 trillion. At the same time, there's roughly $7.5 trillion just sitting in cash in these things called money market funds. So any guesses where those funds like to park all that cash?
You got it. The money is already there, invested in those very same short-term T-bills. So when a T-bill matures, the money market fund gets its cash back from the government. And then, what does it do? It automatically turns right around and buys a new T-bill with that exact same money. The whole system is basically designed to do this on autopilot. So a default? That's not really the issue here. Okay, so if the government isn't going to default, what about the cost? This brings us to the second huge myth, the fear that all this refinancing is going to lock the country into some kind of cripplingly high interest rate nightmare.
And the logic here seems totally solid, right? We've all seen interest rates climb, so if the government has to refinance all this debt, isn't that just like trading in your old 3% mortgage for a new 6% one? You'd think that would make the country's interest payments absolutely explode. But this is where the story gets really surprising. When you actually look at the numbers, comparing the average rate the government is paying now versus today's market rates, you see something interesting. Yeah, for the longer-term notes and bonds, refinancing right now is more expensive. But look at that top line for the short-term bills.
And here's the kicker. The huge majority of that $9 trillion we're talking about is made up of those short-term T-bills. And because short-term interest rates have actually come down recently, it's now literally cheaper for the government to roll over that specific chunk of debt. This just completely flips the whole interest spike fear on its head.
Now, this isn't just some lucky accident for the government. The fact that so much of the debt is short-term and maturing right now, well, that's actually part of a deliberate, calculated financial strategy. So here's the playbook. For the last couple years, the Treasury has been intentionally shifting more and more of its borrowing into those short-term T-bills. They were making a bet, a big bet, that the Federal Reserve would eventually start cutting its short-term interest rates. And now, that bet is starting to pay off, putting them in a great position to refinance that massive pile of debt at cheaper and cheaper rates.
So it looks like a terrifying storm cloud of a crisis on the outside is actually, from the inside, more like a strategic chess move. The government is playing the long game here, using the shifting interest rate environment to try and lower its borrowing costs for taxpayers.
So let's just recap real quick. That scary $9 trillion number? Not an immediate crisis. It's not a default risk because the system is built to roll over the debt automatically. And it's not an interest rate disaster because most of it is short-term debt that's actually getting cheaper to refinance. It's all part of a calculated government plan.
But this whole strategy does have a weakness. It's a great plan as long as short-term rates keep falling or stay low. But what happens if inflation comes roaring back and forces the Fed to start hiking rates again? What happens when your entire strategy is built on cheap, short-term borrowing in a world that suddenly gets very, very expensive? Well, that is the new $9 trillion question.
If you like this video, please hit the subscribe button, like, and share.